Hey everyone, it's Vanch. Today we're diving into the wild world of GME stock, also known as GameStop. We're talking about a stock that went from less than $20 a share to over $400 in days. It all started with a group of Redditors on Wall Street Bets challenging hedge funds betting against GameStop. Let's break down what happened, analyze its current state, and discuss if it's a smart investment or a gamble to avoid. Before diving into GME stock, let's talk about GameStop itself. GameStop is that mall store where you probably spent hours browsing video games. But with digital downloads and online marketplaces, fewer people visit physical stores. This shift hurt GameStop's profits, making Wall Street pessimistic about its future. Hedge funds started short-selling the stock, betting it would go down. They thought GameStop was doomed. Little did they know a group of retail investors on Reddit were about to prove them wrong. This is where GME's story turns into a financial thriller. Wall Street Bets, a subreddit known for unconventional strategies, noticed hedge funds heavily shorting GameStop. They started buying GME stock, driving up the price. As the price rose, more people joined in, creating a social media phenomenon. The media caught wind, further fueling the frenzy. This massive buying pressure created a short squeeze. Hedge funds were forced to buy back the stock to cover losses, pushing the price higher. It was a David versus Goliath story with retail investors taking on Wall Street. GME stock soared to over $480 per share. Let's dive into the charts to understand GME's price movements. The story of GME is a fascinating one, filled with unexpected twists and turns that have captivated both seasoned investors and newcomers alike. By examining the technical indicators and candlestick patterns, we can gain insights into the underlying forces that drove the stock's dramatic rise and fall. Typically, you analyze a stock by looking at financials and industry outlook. This involves scrutinizing earnings reports, balance sheets, and market trends to make informed decisions. However, GME's case was anything but typical. But with GME, it was driven by speculation and social media hype. Platforms like Reddit's Wall Street Bets played a crucial role in rallying retail investors, creating a frenzy that defied traditional market logic. The power of collective action and viral trends became evident as the stock soared to unprecedented heights. The GME chart from late 2020 to early 2021 shows a massive spike. This period marked the peak of the short squeeze, where retail investors banded together to drive up the stock price, forcing short sellers to cover their positions at a loss. That's the short squeeze in action. Short sellers who had bet against the stock found themselves in a precarious position as the price skyrocketed, leading to a buying frenzy that further fueled the upward momentum. The volume of trades was huge, indicating retail investors buying the stock. The sheer number of trades highlighted the widespread participation of individual investors, many of whom were new to the stock market and driven by the excitement of potentially massive gains. But what goes up must come down. The rapid ascent of GME's stock price was unsustainable, and a correction was inevitable. Market forces began to balance out, and the stock's value started to decline. GME's price plummeted just as quickly. The dramatic fall mirrored its meteoric rise, leaving many investors scrambling to mitigate their losses. The volatility of the stock became a stark reminder of the risks involved in speculative trading. Many investors who bought at the peak lost significant amounts of money. The emotional and financial toll was substantial, as those who had hoped for continued gains faced the harsh reality of the market's unpredictability. The key takeaway: GME's price movements were highly volatile and unpredictable. This saga serves as a powerful lesson in the importance of due diligence, risk management, and the influence of social media on modern investing. While the GME phenomenon may be a unique event, it underscores the ever-changing dynamics of the stock market and the need for investors to stay informed and cautious. So, is GME stock a good investment today? It depends. If you're hoping for another short squeeze, proceed with extreme caution. Those events are rare and hard to predict. However, if you're looking at GameStop as a long-term investment, consider its transformation. The company is shifting from brick and mortar to e-commerce and digital gaming. They've brought in Ryan Cohen, co-founder of Chewy, as the new CEO. Under his leadership, GameStop is revamping its website and exploring new ventures. Whether these efforts will turn the company around is yet to be seen. Investing in GME stock is high risk, high reward. The The company is still in turnaround mode with no guarantee of success. GameStop is losing money and has substantial debt. The competition in the gaming industry is fierce, but there's potential for significant rewards if their e-commerce gamble pays off. They have a loyal customer base and strong brand recognition. Be realistic about your expectations. Don't pour your life savings into GME. If you believe in GameStop's long-term vision and are comfortable with the risks, allocate a small portion of your portfolio to GME. So there you have it, the wild ride of GME stock, explained simply. We've covered the short squeeze and GameStop's future plans. Remember, investing in volatile stocks like GME is risky. Don't invest more than you can afford to lose, and always do your own research. For more investment guides, subscribe and hit the notification bell. Until next time, stay informed, invest wisely, and keep crushing it.